So what I'm going to do is consider investing $200 every month for a year. So that gives me $2,400 that I'm investing total. So this black line on the graph, this black line is $2,400. Now, this red line is lump sum. That is, I put the $2,400 in at the beginning of the year and let it ride out. This blue line here is dollar cost averaging. So first I put $200 in, and after a month I put another $200 in, and then another $200 in, and so forth. So at the end of the year, I have put in $2,400. Now it's important when you compare the blue to the red that you do it under the same market conditions. So here I simulated a market over here. I have some random walk constant, and this is just a very simple, very simple simulation here. I have some ideas on how to improve it. So I flip a coin, basically this random number, that generates a market direction for the day. And then what? So then I multiply the previous number by this market direction, and this random walk constant's also used. Okay, so by that formula right there. And that process is done to the lump sum as well as to the dollar cost averaging using the same market direction and magnitude and this random walk constant. And you just do that for all the days going down, and then you graph it. Now so this is all random. Okay, so let me press F9 to generate some new realization of this simulation. There we go. Okay, so here what I have is the dollar cost averaging. It finished at 5,041, which, remember, we started both of them. Both of them end with 2,400. So that's a gain of 2,521. Now the lump sum finished at 7,806 all the way out here, right? So that's a gain of 5,396. One thing you have to keep in mind is commissions. So I just assume, commissions are $10 per buy. So lump sum, you just buy once at the beginning, so that's $10. But dollar cost averaging, you buy every month, so that's $120 total commissions. So I consider a with commissions winner and a without, this is a without commissions winner, and this is a with commissions winner. Okay, so let's look at what I want to look at. Okay, let's look at another realization. So this one, dollar cost averaging, was the winner, but they both underperformed what you would expect them to. Same there, same here, same here. Here, lump sum in red was the winner. Let me just generate a lot of realizations. What I want to show from this is that it really depends on the market conditions, which should be obvious, but people really like arguing about this stuff. So here's one where dollar cost averaging won. Okay, dollar cost averaging. Okay, let me show you this one is interesting. So, and again, dollar cost averaging, you see that typical step function. But without commissions, dollar cost averaging won, right? The blue line is higher than the red line. But when you take these commissions into account, lump sum wins. So you always have to include that. So one way to improve this would be to take, when you're doing the dollar cost averaging, so the first month you put in the 200, but you still have 2200, right? The 2400 subtract 200 that you haven't invested yet. It's to be invested. So that money could be in some other investment gaining interest. So I think a more thorough analysis could take that into account and also take into account just a better simulation of the market conditions. I'm just doing a random walk. It's about the simplest case you can do. That's why I did it. But you could improve it quite a bit. I'm just going to do a bunch more realizations, maybe a couple minutes worth, so you can see the, just kind of see what can happen. It might also just depend in real life, 2400, I mean, it's all relative. That's not a gigantic amount of money. It's still a pretty big chunk, to me anyway. So it might come down to, how much money do you have on hand? Most of us could do, a couple bucks every paycheck, right? So in that sense, a dollar cost averaging might so-called win just because it's more practical. So I did this a bunch of times on my own, like, I don't know, I think I did it like 300 times or something. And it was pretty close. I mean, it was pretty much 50-50. You couldn't really say which one was best. And again, it doesn't really surprise me. Once I try to look at it objectively, not use specific time frames, not use specific stocks, then the pieces kind of fell into place that it really just all depends on the market conditions at the time. So let me do a couple more and I will end this video. But I hope it gave you a good sense of dollar cost averaging, lump sum, and just some of the ideas around simulation as well. Okay, everybody. Hey, I appreciate you watching this far, and I'll see you next video. Bye-bye.